We are live.
We are live. Welcome to Stock Talk episode 27. And I hope that you are excited as we are because we have an extremely exciting agenda today. Going to be talking a little bit about AI and investing. Also, Daniel and I are going to go through how we use a discounted cash flow tool to become better investors and try to just think of where stock prices are going. So that should be a really fun one. And we have our first ever guest coming on about halfway through the show, Stockado, which is going to be super fun. And if you're enjoying the streams, you come every week, please hit that bell icon to get notified when we go live, smash the like button, and we are also on Spotify now. Daniel, good morning. How are you doing?
I'm doing great. How are you doing?
I'm doing great. I know you were in Asia and then you came back and you had a cold, for those of you who are following along. It doesn't sound like you have a cold and you look well rested. So are you back in the Canadian groove now? Everything,
Yes.
Everything shaken out from the trip?
Yeah, we're back, baby. We're ready to go. Also, before Stockado comes on, I just want to let you know it's not Stockado, it's Stockado. But yeah, we have our first guest later. It's going to be awesome. It's going to be fun.
Well, you can tell it was our first guest. I just had a really good crash course in making sure that you can pronounce the name correctly. So hopefully that is a one-time issue.
You've clearly been preparing a lot.
It just looks like, well, actually, I just argued against myself. I was about to say it looks like avocado, but then that still doesn't back up how I pronounced it. Anyways, more important things to get into today.
Fine.
I became a subscriber, or should I say to ChatGPT 4, 3.5. It is talked about a lot, obviously, that the AI revolution is so-called here. I thought an interesting conversation to have would be how investors can be looking at AI when they look at long-term stock investments. Obviously, we are more long-term investors than short-term. Daniel, how has AI been affecting how you are looking at stocks in the market?
Almost not at all.
Interesting. So I have been thinking about AI a lot. So let's just use an example here, Netflix. So one thing that AI is doing really well is it's making it easier and easier to create content. The cost to create visuals and things with Stable Diffusion is going down. So when I think of stocks like Netflix, for example, I try to question what their moat is. I thought their moat was questionable before. There's lots of streaming services. So if it's going to get easier and easier and easier to create the content, where is their edge? We already know that competition's coming in. And on the contrary, you won't be surprised to hear me say, when I think of companies like Airbnb, it's hard for me to imagine how AI is going to create more houses or get that marketplace going again. So yeah, those are some of the things I was thinking about there. But it's interesting to me that you're saying you're staying clear from it, right?
Yeah, I mean, I just don't know if we're there yet to really start worrying. I mean, if you're talking 5 to 10 years out, then yeah, I would agree that AI is probably going to start making some pretty crazy content, which also, as a YouTuber, that's not fun to think about. But I actually know that some people are using ChatGPT to start writing videos, like writing scripts for videos. So I haven't done that, but I have seen some people start doing that. But yeah, I don't know. We'll see. We'll see how it plays out. Right now, though, I'm not too concerned about the stocks that I currently hold and what AI is going to do to them. But
well, you do hold a couple stocks where I think AI definitely has a huge gameplay. So you are a shareholder in Google as well, correct?
Yeah, but I mean, they've been the leader in AI for over a decade. So we've talked about this before. I just don't know what's going to happen yet. So I think it's a little bit premature for me to make moves in my portfolio when I haven't seen anything happen to the fundamentals or the numbers yet. Because everything right now, I think, is just speculation. Who knows? Netflix may maintain some sort of moat. Maybe they'll be the AI content generator. They'll have some formula that works better than everyone else. We just don't know yet. No one knows. So yeah. I don't want to make moves in my portfolio based on just what I think is still speculation.
I definitely agree on the speculation note because you can come at this from two sides. On one side, AI is going to, theoretically, speculation, but we see it bringing down the cost to do things like create content, stuff like that. So you can then say, all right, well, if the cost is going down to produce content, then it's going to be easier and easier for people to just use prompts to make shows and things like that. And you start to question, well, companies like Netflix are spending, tens of millions of dollars on content. Amazon's doing that too. However, you could also see this as a positive thing for them because they could also obviously use these technologies.
I was just about to say,
Yeah.
I was just about to say, yeah, I mean, you could flip that and be like, oh, well, maybe their cost is going to go down massively, which makes them much more profitable. Like, who knows?
Yeah.
I don't
And I
know.
can say as a consumer too, like other conflicting things I feel is there's a real conversation about search here, right? Like, is Google set up to win because they have the most data? They're already ingrained in your search bar and everything. I think that's a huge moat. But you also, even for me as a consumer, I started paying $20 a month for ChatGPT 3.5 and 4 this week. And I'm now using both that and Google. Now, I'm not going to make a claim. What does that mean for Google's business model? Like you said, it's a lot of speculation at this point. I guess I could just say, at least for me as an investor, I am looking at it a lot. And like you said, it's mostly observing, but I definitely believe it will be changing things in the future.
One thing I find interesting, though, is like I've heard a lot of people say that ChatGPT and Google, like the use cases are pretty different. So have you noticed yourself doing a less Google searches now that you have ChatGPT, or are you using ChatGPT for like a totally different use case?
It is completely about access. If I had ChatGPT available just like Google was, where I have a Pixel, I'm a Google fanboy, so my phone's Google, everything's Google. It's just right there for me. But I find the answers are usually a little worse. There are some small use cases where I know Google will get something right, and I don't want a huge conversation. So there are still things where the conversation is actually annoying. And of course, everyone feels like Google could just flip a switch and kind of turn this on as well. So what I'm hoping for, as well as Gmail integration and things like that, is to just have it already integrated in my Google products, where OpenAI, ChatGPT, I still need to like log in through a web browser, go through this extra step, which might sound like, okay, cool, first world problems that you have to log in. But I think ease of use is incredibly important, especially from the consumer standpoint. So
Yeah, I've been taking a look at the search um, market shares, and Google's market share is still maintaining. So far, it looks like it's not really making too much of an impact on their business.
yeah, well, we'll see what happens. And good morning, everyone, to the chat. A little bit too many names to run through them all today, but appreciate you guys all coming. We would love to hear some of your opinions on this as well. If you want to drop some comments there, and if you're just lurking, again, make sure to hit that like button if you're enjoying the stream. It really helps us get more reach.
Let's hop into some DCF stuff.
I was just about to say that. Lead us off with the first stock here, Daniel.
All right, so I am going to show everyone. Oh wait, how do I do this? Let me do this. I'm going to put this over here, and then I'm going to do this. Boom. You guys can see I'm rating our
I was
subscribers.
going to say, there's a little sneak peek there.
The subscribers only newsletter that's going to be sent out later today. If you want it, you got to be a subscriber to Stock and Log. Okay.
So from the perspective of a newer investor, Daniel, what flow do you walk through, and what would bring you to this type of tool? What kind of questions are you looking to answer with this?
Okay, so this is our discounted cash flow calculator, DCF for short. This is basically a tool that I think not very many beginner investors use this. And to be honest, when I was a beginner investor, I did not use a DCF calculator. I still don't use this as like the holy grail of investing, or, like if I run a DCF and it says that a stock is undervalued, I'm not going to be like, okay, I'm buying it today. It's a part of the analysis, not the full analysis for me. And I use it to try and put things in perspective to understand how a stock is valued today. So that's one thing that I actually do with the DCF is I try to understand what is currently being priced into the stock right now. And then I ask myself, like, is that too optimistic? Is it pessimistic? And then is there an opportunity there, or should I be avoiding it? So we're going to take a look at Apple first, because you know what? I'm not going to give you my opinion. I'm just going to show you what I think. So
what?
That may have been worded stupid. I'm sorry. Anyway.
No, it's this is all what live show is all about.
Yeah.
I was going to say just one quick thing for the newbies here who don't know how to approach this. I think one thing you really need to understand is earning multiples. So that I think would be the dependency on really understanding these tools. Learn about price to earnings ratios, because this is a forward projection. And thank you for letting me do that quick interruption. Which one are we going to look at here, Daniel?
Okay, so for Apple, I like to look at the free cash flow, and I'm going to use 10 years. I like to have a little bit longer of a time frame. So what our discounted cash flow calculator is going to do is you can select the metric you want to use. We have a couple of videos on our Stock on the Lock YouTube channel going through when I believe you should use earnings, free cash flow, operating cash flow, all of it. Those are very in-depth videos if you want to know what metric to focus on. So with Apple, I believe free cash flow is the best. Again, I want to project out 10 years. And what we do here, we automatically do the autofill. You can turn that off. But over the past 10 years, Apple has grown its free cash flow at an annual rate of 8.63%. So basically, our DCF will take this and then just project it out over the next 10 years. So what it does is it makes the assumption that Apple is going to grow over the next 10 years as quickly as it did over the past 10 years. That's the best we could do. I don't know if you want to believe in that or not, but I think that this is actually a little bit too optimistic in Apple's case. I think that they're probably going to grow at like 5% or 6%. Let's be optimistic. Let's say 6%.
Yeah, and one call out on this, especially for newer users, the autofill is a very great feature in Stock and Lock since it will seed values that our software, just looking at past financials, think are sane. However, it's definitely up to the user to really understand what's going in here, since the price that's going to be output that Daniel's driving us to is very dependent on your input. So this is not a real estimate or any kind of guarantee. It is the investor putting in what they think will happen to the business. And based on how it's traded historically, if the stock does grow, you can create some reasonable theses around, okay, this stock might actually be worth X in the future based on how it's grown in the past. But yes, very good point there that it is a little dangerous to just take those at face value and not understand them. So it's worth turning on education mode for new users. And we got question marks in the video to walk you guys all through it.
Yeah. And then the next thing is the shares outstanding growth rate. They've bought back about 4.7% of their shares outstanding annually. They're probably going to continue doing that in the future, so I'll leave that. Price ratio over the past 10 years on average has been 16. I'll just leave that. And a 10% discount rate is basically the rate of return that we want. So basically saying over the next 10 years, if Apple can grow free cash flow at 6%, buy back about 4.7% of their shares, and trade in line with their historical average price to free cash flow, then the stock's fair value is $111 or 32%, basically 33% if you want to round up, below where the stock is currently trading. So this stock today, based on these estimates, will not give you a 10% annual return. It will give you about a 6% annual return. Sorry, my cat just walked in. So basically what I'm trying to say is I think that Apple has just become a little bit expensive in the market. If we actually go and take a look, go to Freeform. I just want to show everyone Apple's price to free cash flow and what it's been doing recently. Oops, price to free cash flow. Because now it's trading around 27, which is well above its historical averages. As you can see, it's like actually near the high end. And Apple's revenue it's been kind of stagnant for almost a year now, and it's actually starting to come down a little bit. So I think that, a 27 price to free cash flow for a business where the revenue isn't really growing anymore, at least for right now, is quite expensive, which is why, that's why I wanted to run it through the DCF and kind of just show my thinking, because I think the market is pricing it for quite a bit of growth.
Can we scroll down the page a little bit? And I found that interesting too. So you went to the Freeform to try to validate your assumption. And some people might be looking at this who are on video and say, wow, this looks like Apple stock price is going to 2x. However, do you believe that that's where their free cash flow will be at in 10 years? Because that's the assumption that this calculator is making. And going back to the Freeform tool, Daniel, I think that's a really great strategy to look influence for how to put these numbers in. You go to their financials and really try to look at their product, see where they're innovating, and not that we can predict the future, but use our best educated guess as to where those will be in the future. Yeah. So what if we take that down to like 2% growth rate? What would that do to the fair value?
One thing first, what I like to do in the DCF, what I just did is changed the growth rate to find out about where the fair value is. So you can see for Apple to be fair value right now, it would basically have to grow its free cash flow at 10.2% to give you that 10% return, which would mean its free cash flow would have to 2.5x over the next decade, which I don't know if it can do. I really don't know. So basically, I would look at this then and say, I think that this is too optimistic, and this is what the market is currently pricing. So I think that this is too optimistic for me, which means that, I could come to the conclusion that maybe it's not an investment that I would necessarily be happy buying right now. But that's just me. I don't know if Apple's going to outperform or not, but that's just kind of my opinion on it.
Yeah, I mean, we can go into a whole on Apple. I am just not a consumer of Apple products, and I know you aren't either, so we might have a pretty unfair conversation about it. But they've obviously built a dynasty, and it seems like the world's running on iPhone, or at least half of it. So, gotta give credit where credit's due. But will they continue that in the future? I don't think so.
Yeah. Actually, this was another one I wanted to do, Jake. Let me know if you want to run through one, but someone just asked what would be the fair value of Equitable Bank? And could you show another example maybe for Microsoft?
Yeah,
Do
thank
you
you
mind
so
if
much
I
for that suggestion. Let's do it. I've
Right.
got one, but we've got time. I think we have about 13 minutes until Stockado is coming on. Pronounced it correctly that time.
Thank you. Yeah, okay. So we've already explained the freeform tool now, so I am just going to run through really quick. So with Equitable Bank, this is a bank. So I like to use the earnings number. Now, again, we have the autofill on, so this is all of Equitable Bank's just numbers over the past decade. I like to be a little bit conservative whenever I'm doing these. So I actually don't think Equitable Bank is going to grow at about 13%. I'm going to be a little bit more conservative, just say 10%. Shares outstanding growth rate, I'm going to leave that the same. Price ratio, leave that the same. Actually, no, the price ratio, I think that over time it's going to expand and they're going to be more in line with other banks. So I think it's actually going to expand to about 10.
And this is a great mindset too, right? I mean, as other investors go and use these tools, these are the exact questions you should be asking yourself.
Yeah. Also, this isn't the best right now because Equitable Bank had some major one-time charges related to an acquisition. So their earnings is actually down right now. But anyways, assuming that
We can override the last metric, which is a feature that a user actually asked for that we added a month or two ago. Which
yeah, I
here
don't
we go.
have the number on the top of my head though.
Got you.
So yeah, maybe I should do that honestly. Let's do Microsoft because this isn't going to give an accurate picture because I don't have the
You
number.
are not a shareholder of Microsoft, correct? Because I am.
I am not a shareholder of Microsoft. Microsoft, I would use free cash flow. Um, all right, so let's just take a look at their autofill metrics. So this is just projecting the past 10 years out. And this says metric growth rate to free cash flow about 9%, buying back shares, yep. Price to free cash flow ratio of 23, 10% discount rate. Sorry, 10%. And that says fair value is 31.5% below where it's currently trading and about $196. So based on Microsoft's their last 10 years, if they do that again and they grow at about 9% over the next 10 years annually, then the stock looks like it is actually expensive. So what would they need to do? Let's do 13%. 13.5.
If
Okay.
we scroll down, what would that bring the total value to at the end of 10 years?
Yeah, I'll take a look at that. But
Cool.
basically, Microsoft right now is priced as if it's going to grow its free cash flow by 13.5% a year over the next decade, which would end up being $211 billion in free cash flow. They did about 60 billion in the trailing 12 months. So they would have to basically more than triple free cash flow over the next decade to just be fair value today.
That looks like an aggressive assumption. Not that
Yeah.
we can predict the future. I mean, that would be great. I'm a shareholder. I'm looking at that. I'm like, if Microsoft does that, I mean, I'd be a monkey's uncle. That is an incredible amount of growth on an already very large base. So
Yeah. And the thing about Microsoft too, like this is also giving it a 23 price to free cash flow, which is a little bit more on the rich end. So I don't know, like if we go back to our freeform tool and we take a look at Microsoft here, it's kind of been doing the same thing as Apple, where its price ratios have just continued going up and up and up for quite some time. Like it's basically just been continuing to uptrend, and now it's trading for a price to free cash flow of 36. So that, in my opinion, like that's a very expensive multiple, especially on a stock that's like already so big. And yeah, I mean, the market's just pricing Microsoft like it's going to grow its free cash flow very dramatically over the next decade. And like if they don't hit this, then the stock's probably not going to deliver amazing returns. So
yeah, we
basically, I just think the market's pricing it for it's just being very optimistic on Microsoft, in my opinion.
we have a good comment in the chat here from Ali. Also, this member of Stock and Lock is the person who is helping us out with the podcast. So shout out to you. Thank you so much. AI wars are at play. And Daniel, my comment was going to be not that I'm speaking for us, but just looking at the stock price, it seems that people are pricing in or giving Microsoft a higher multiple because of their place in AI. Yes, this is very speculative. And as you mentioned, that is adding more risk to the stock, especially when people start thinking of margin and safety and things like that. You can kind of see this is a very well talked about stock, and it seems like people are pricing that in. Maybe they'll be right, but look where others aren't is what a lot of other people would say. I personally was buying this at around 225. My average is 223. Not financial advice. I'm just kind of watching it at this point. I do those all for long-term holds, no intentions on selling. Great company. But yeah, it's definitely flying pretty high with all the AI craze going on.
Yeah, it's just pricing in a lot of growth already. It's basically like even if Microsoft does grow free cash flow by 14% per year over the next decade, like it's already pricing that in basically.
Definitely. And I'm going to share my screen here and just walk us through my stock. Many of you know I'm very bullish on Airbnb. I have continued to do a lot of research, especially on the short selling reports and things like that. I will bite my tongue because I do love having my bull rants about them, but just keeping it to the, oh, it looks like I'm logged in on a guest account. Just keeping it to this DCF. So Airbnb, obviously they sell rental properties. This company has around a 40%, I forgot the exact number, free cash flow margin. So they are extremely profitable on the revenue that they break in. Daniel, I know you said 10 years. I'm just going to throw in some more opinions here because I think it's up to the investor of how to use this. I feel a little bit more comfortable with 5. There's no right or wrong here. For me, I think 5 is a little bit easier to just kind of like stomach and feel confident about. I think 10 years is very hard to predict.
Yeah.
However, yeah, and again, no right or wrong there. So what I like to do with Airbnb is I like to value them on free cash flow since they are profitable. They have positive free cash flow. I personally think this company is going to continue to grow very rapidly. So I am putting in a 15% growth rate. I think 37 price ratio is a little bit high. So I'm actually going to lower this down to 30. This is still very high. I understand that. We were just looking at Apple and Microsoft, and we both agreed, hey, 27 is high. However, I'm going to use the Amazon argument here that when you have a business that has such a huge moat and is growing as quickly as Airbnb, my opinion, which I know you might disagree with Daniel, is that this company will continue to command a high earnings ratio based on their growth rate and their amazing leadership. One thing I love to focus on too is this does seem very sane to me. So for those of you who are just on audio, we are looking at, well, if we project their future growth rate by 15% for 5 years on their free cash flow, which was reported as 3.41 billion in the last trailing 12 months, that would bring us all the way up to 6.85 billion in 2028. I think that's very possible. Just my opinion, not financial advice. So, we've been running through these numbers a lot, but these are the tools I like to use when thinking about long-term stock prices. This is obviously a big bull case. I think you should do your own research, and there are people who disagree with me here, but these are one of the reasons why I love Airbnb. And as they make more money, I continue to see them having very, very high free cash flow margins and being a very profitable business. So any comments here on Airbnb, Daniel? Any fun arguing you want to have about this one?
I think those are pretty optimistic numbers.
Yeah, that's the side I'm taking on this. I'm very bullish on Airbnb, and that's what makes investing fun. I do know we did have some comments on the last stream. I just want to let everyone know Daniel and I are super close friends. If anything comes off as like a little bantery, I mean, that's just how we are and our personality, but rest assured that, we are both very happy and feeling good about things. I can also definitely make sure I'm standing up for myself if I feel that Daniel ever crossed the line. But Daniel, I don't think you ever do. I genuinely love when we disagree on things. I think it's a lot more fun than when we agree, personally.
Yeah, I just got to stop bullying you. Anyways, all right. So while Jake was going through Airbnb, I went to Equitable Bank's most recent earnings report for the full year of 2022. I found their adjusted net income right here of $326 million. Again, they did an acquisition in 2022, which they had a lot of one-time expenses. Personally, I'm happy to remove those because, again, I think that they're one-time expenses. So this is like what the bank would have done without the acquisition costs. So going forward, this is probably what they're going to more likely produce in the future. So what we can do over here on our DCF tool is add in the most recent metric override. So if there is some adjustments you want to make to the numbers, you can enter in the number that you essentially want. And that's what I'm going to do here for Equitable Bank. So now I'm going to drop that growth rate back down to 10%. I'm going to say price ratio expansion to roughly a 10 price to earnings ratio, 10% discount rate. That's the return rate I want. And we can see here that the fair value is about $71 a share with these assumptions here. Future stock price will be 210% above, and the compounded annual growth rate will be about 12%. Now, one thing that our DCF does not do that we want to build is show the dividends as well, because Equitable Bank does pay about a 2.3% dividend today, and that should be added to the compounded annual growth rate and fair value. So in the future, we will have dividends, hopefully. Don't know when that will come, but yeah, that will give a more accurate representation of the earnings. And then based on these estimates right here of 10% earnings growth, that means the bank will be producing about $846 million of earnings by 2033 relative to 326 today. I don't think that this is like super unrealistic. I think they can probably do this, to be honest. And if they do, then I mean, the stock looks pretty cheap.
This is when I say I think that's extremely optimistic, friend, but that is what makes investing fun.
Yeah, we'll see.
Yeah. And for those of you watching, one great thing about Stock and Lock is you are looking at 2 out of 3 founders here. That metric override was a direct ask in our Discord from a user who wanted to be able to override that. And as Daniel said, we have a lot more in the pipeline with dividends coming through. So whether you're just in your free trial or you're already a subscriber, please reach out to us on our free Discord email. We are very excited to just make sure we're building things based on your guys' feedback. And quite honestly, do believe that it is one of the best investing tools on the market for retail investors today. Of course, I'm opinionated, but I think it's back.
Jake.
Oh, we're close to Stockado, right?
Yep. I'm going to let Stockado into the stream. Here we go. Hello, Stockado.
Hi, how are you guys?
Great. How are you doing?
I'm great. I'm actually out of town, so that's why you see a different background over here. And I'm great. And Jake, hi. It's the first time I'm seeing you, so nice to see you. And thanks, Daniel, for having me. I'm a huge fan of your content, so it's really nice to be here.
Awesome. Well, hope you're doing good. Thanks for coming on the stream. We've been talking about you coming on the stream for probably over a month now, but with me in Asia, like it was just a little bit too hectic. So happy to finally have you on.
But the trip seemed really nice, by the way. I was looking forward to more images. I was a bit disappointed there, but it seemed amazing. It's good. I should do the same probably.
Yeah, it was a good time. So yeah, what we like to do on these streams is just talk about stocks we're looking at, stocks we're bullish on. So is there anything in the market right now that you're taking a look at or researching or even buying?
Yeah, okay. So let's fragment that, and I'll take every question here. So regarding buys and sells, I had more sells than buys recently, at least. So some companies like BAM, for example, I'm pretty sure you're not going to like this, but I sold the entire thing. I had HDB, sold the entire thing. It was mostly because during November, December, as the market started switching and recovering, I knew that names like BAM, for example, and other conventional names, the growth rate here is going to be limited. It's going to be 17 to 19%, give or take. In my case, the average portfolio growth rate I like is above 20%. So that's why it made sense to switch these names. And that's the first thing. Regarding buys, I bought some small caps. I'm not sure if I should disclose small caps here. Probably it's too risky, or should I?
That is totally your call. Just know that you would be representing Stockado and as opposed to Stock and Lock there. I tend to avoid the ones that are too small cap, so I'm invested in one that's around like 20 mil.
So less than 1 billion is okay. It's 800 to 1 billion. That's fine, right?
Yeah, I would say that's okay. Yeah.
Go for it.
So the name is Alpha Group. It's a British small cap anyway, so that's why I'm not so worried, because it's not available to US investors. So it's an FX management company. It's growing by 40 or 50% every year, 40% EBIT margins. So it made sense to switch towards these names. And regarding the
one,
so the ticker here would be, they changed it actually. So let me give it to you. Just give me 1 second. It's ALPH. And that company is growing by 40% every year, and they expect to maintain that momentum. If not, increase the growth rate here, because they introduced some new products here. So 80% is FX management. So let's imagine you guys, for example, let's say you're based in the US and you're selling to European clients. So you have the FX management there. So these companies could actually give you tailored solutions. And that's why it's growing at such a rapid pace. And now they launched one new product, which was for asset management, alternative asset management. And that product is also growing like 60 or 70%. Well, once again, it's a small cap, so please keep in mind it's really volatile, risky, very liquid as well.
Yeah.
And regarding the overall market, I track so many sectors, man. It's crazy. Like retail, tech, AI, because I know you were talking about AI just a minute ago. So I tracked all these names just to see where the market is heading, and if I can just take one or two trends every year, that really helps the portfolio out.
Definitely. And we are making history now. You are the first guest. I think that there are a few people in the audience who are familiar with you, Stockado. There's probably a few who are
Thanks.
not. So I already love that we started off. You're selling stocks, Daniel's holding. I love this. Maybe you could take just a minute or two just to describe your investing style, specifically around, are you more long-term, short-term? I know you said you go cross-sector. Like, what is your vibe? Where do you specialize? Are you a generalist?
Yeah, I wish I had a fixed answer to this. I had a feeling this question is going to show up, and I was thinking, how can I actually answer this? I was preparing since yesterday, so let's see if I actually nail this. I don't have any criteria. I genuinely don't. But I will say this: like the first metric I like to start with is revenue growth. Like I focus on profitability, margins, free cash flows, everything. We'll talk about this in a minute. But I start with the revenue growth because if your company isn't growing by, let's say, 15 or 20%, there are certain economies like India, for example, the economy itself is growing by 8 to 10%. So just invest in an index there and you'll be just fine. So if you're taking some risk investing in the market, you might as well get compensated over here. So I start with the revenue growth because when it comes to margins, yes, okay, you can improve your margins from, let's say, 15 to 20%, 25%, but eventually you hit a ceiling over here. So start with the revenue growth and then everything falls into place. And then operating margins, I don't have anything fixed. Like I could go with a company with 15% operating margins as well. And when it comes to free cash flows and stuff, if a company is reinvesting everything they have, you won't see free cash flows.
Yep.
Like for example, and this is why I suggested one company in the previous stream. I suggested a company called Floor and Decor. So if you check their cash flows, you'll notice they're actually negative. And they said it'll be negative for the next 4 to 5 years. But then when you understand the dynamics behind that, this company is growing by 30 to 35%. Just so everyone knows, this year it's going to witness a slowdown, just so you know. I'm going to warn you in advance. But if your company is growing by 30, 35%, and they can reinvest everything, obviously the free cash flows won't be there.
Mhm.
And then if you take operating margins, that's also, I need to be flexible there. For example, just so you know, I own Palo Alto. If you check their margins, you'd say, well, the margins are pathetic. But then you see, well, it's actually because they're spending so much on sales and marketing when they don't have to. So for example, Jake, just 2 minutes ago, you were talking about Airbnb. That company is so amazing because they have variable costs. It's not so much fixed costs. Sales and marketing in 2020 and 2021, Airbnb decreased it completely. I think it went down by 80 or 90%. Tell me a business that can take that variable cost down so much and still grow. That's what happened with Airbnb.
Well,
So
they're a verb now too. That market themselves to
precisely,
their consumers.
exactly, that's the thing. So all these things, I need to put them into perspective. So I just don't see the headline like 30% operating margins, not a big fan, let's skip it. I don't do it this way. So I just study each item and see if it fits. But I start with the revenue growth. That needs to be there for sure.
That is a great intro. Thank you. And Daniel, I'm assuming that we both have the same question. So I just want to dive a little bit deeper into that. One thing I'm sure that we would agree on is companies need to make money. And when they're not making money, the money is coming from somewhere. And I think that there are tons of incredible growth stories. And I totally agree with you. We could look at Amazon where revenue is going up, people are reinvesting, you don't see the cash flows. However, there is another side of this coin, and we need to maybe find a middle point where if a company's just burning money forever, that also isn't good. So when you start threading that needle there, maybe we could even think of an Uber, right? Because you looked at their revenue maybe back in 2019 to 2021, and then their operating income went like that. So what is like a level of unprofitability that you see? And are you looking out and saying, I expect that this company to flip profitable at some point? Are you like riding a swing trade saying their revenue growth, they can do whatever they want with that? Because that does go, I think, a little bit against the grain of what we do here at Stock Unlock, which again is not right or wrong. It's why we love getting alternate perspectives of different types of investors here.
I don't think it's alternative perspective. Maybe I'll try to defend myself here. It's just I'm investing 2 years before you. So I'll explain what I mean by this. If you take a company like, once again, we'll take Palo Alto because it's one of my biggest holdings. So this company wasn't profitable just 2 quarters ago. I invest and it became profitable the next quarter itself. And now the EPS is going to grow by 50 to 60% because that scale kicks in. So it's not like I'm investing in companies that are just burning money. It's just the market doesn't see it's profitable, so they're cheaper. And then just in the next 3 to 6 months, they become profitable. So just
Yeah.
2 months ago, I bought another company. It's also small cap, so I won't name it here. I just
Mhm.
bought it, and they said in the next 2 quarters, once again, we are going to become profitable. So you get actually multiple things at the same time. Firstly, you get the re-rating happening because it was cheaper, now it becomes expensive. Then the revenue growth rate kicks in, and then you have the margins which expand significantly. So I'm just giving myself multiple catalysts because I don't know which one will kick in. Now, if all these things kick in, then it's freaking amazing. But at least this way, I have some choice. If market is not happy with the revenue, it's happy with margins. If it's not happy with margins, it's happy with a cheaper valuation. So it gives me multiple optionalities to play with.
Yeah.
Definitely. So I
It's
imagine you're looking. Sorry, Daniel, go ahead.
no, it's definitely interesting. And the Stock Unlock subscribers newsletter that I'm writing right now is actually on a business that's flipping to profitability right now. Nubank, I'll just tell everyone, it's the
Sure.
Berkshire Hathaway growth stock. And
Yes.
yeah, you can see it, like they're unprofitable, and then every quarter they flip to profitability, and now they're starting to generate hundreds of millions.
Precisely.
Yeah. Um, I definitely don't think it's black and white. Like, for example, over the past couple of years, we saw a lot of Kathy Wood stocks, if you want to call them that, where they grow top line, but they dilute shareholders so much to grow revenue by 20-30%. So
Yes.
I definitely don't think it's just like a one size fits all. And I like that you kind of analyze the business itself and try to really understand, like, okay, they're unprofitable right now, but they're going to be profitable. How are they going to do that? And is it realistic? Because I know that a lot of companies can throw out an investor presentation like, oh, we're going to generate billions in the future, give us 5 to 10 years. But then you have to ask yourself, like, okay, is that actually going to happen? Or is this just them trying to get some investor cash? So,
Yeah,
yeah,
yeah, I'd say there are some companies that you know beforehand that they'll never become profitable.
yes, yeah.
You know that, and but they will show you revenue growth. So a
Hmm.
company I analyzed last year was Teladoc. I knew they wouldn't show you profits for several quarters. So
Yeah,
that's not what I'm saying. I'm just saying that investors eventually. So Palo Alto, for example, is the biggest cybersecurity name. It's not a small company, more than $50 billion of market cap. So I'm not revealing a secret here. But the thing is, it's not in your radar normally because if you go on Twitter and you write cybersecurity, for example, you'll see names like Fortinet, CrowdStrike, but you'll never see Palo Alto because it wasn't profitable. But once it becomes profitable, people will say, oh, this company is amazing. So it's not like I'm picking companies that will never become profitable. I'm just a bit early because I want that catalyst to kick in sometime it will. So
yeah,
that's the only thing. And most of my companies are essential items. So it's not like discretionary spending apart from LVMH. And in the case of LVMH, I would say my entire portfolio, you'll see that margins are improving every year. So I want myself to have these multiple optionalities. That's pretty much it. But when I say revenue growth, I'm not saying 80 to 90%, by the way.
yeah,
It's sustainable revenue growth, something
yeah,
like 20 to 24%. Some businesses are made that way. So if you go with the cybersecurity industry, that industry itself is growing by 12%. So for a big company to do, let's say 20, 22% is nothing out of the ordinary. Payment space, it's also growing by 10 to 12%. Cloud space also 10 to 12%. Semiconductors, certain semiconductors. So it's just the sector is growing and the players are just sitting there and they're getting the benefit.
yeah.
Let me know if this is a fair summary. That was great. Thank you for walking us through that. So you are not saying I only invest in revenue growth. Of course, you did not say that. I think you are looking at the sector growth as well as the management when they're putting out their forecasts and saying, can I believe this management? Are they running this business well? And maybe if there's 100 businesses that are growing top line revenue and not bottom, you'll look through those. And it doesn't mean you'll like all 100, but you're going to find the stories where you say, hey, people like Jake and Daniel, they're missing out on a lot of opportunity because they focus too much on fundamentals. I'm going to try to get a little bit of a future sight on this one. I'm not sure if you saw our last stream. I actually brought up Chewy, which I am not an owner of, and I think is a very
I know
high
that
valuation
space,
today.
right?
However, I am thinking of Chewy a lot when you're talking about this because just looking at their business, decent growth last year, slightly different story, but in my opinion, moat management seems good for the exception that the CEO is selling a lot. But yeah, I think this is an incredible style, and it seems like it's working well for you too. So we're learning. We're learning as well. Appreciate you sharing all of
The,
this.
the thing is, every 1 to 2 years, you'll see that a different investing style works.
Yeah.
So it's good to have companies that can do multiple things. Like firstly, as I said, essential items, you'll spend them every year. So like you said, Chewy or Zoetis, these two companies that are in the pet space, they will grow every year. Now, I'm not saying Chewy is going to become extremely profitable. That's not what I'm saying. But when it comes to growth, there will be there even during bad years. If we take this year, many companies will witness a slowdown. We already expect that. But if your company can grow by, for example, Daniel likes HDB. So if you have a market where the market is growing by 2%, but certain companies can grow by 20%, obviously they will do well, even during bad times. So having that sustainable revenue growth actually helps you during those tough times as well. Because the market knows, oh shit, my company is growing by 3%, but Costco is growing by 10%. So it gets a premium as well. So during bad years, the performance is just 10%, plus you add a re-rating as well, and you get decent gains. So last year, for example, I knew that this wouldn't work. So I had safer names. But now I know the market is recovering and people are going to take more risk. We can see this with certain companies where they're going up by 100 or 200%, like Nvidia, just like that. So obviously people are willing to take the risk. So you need to position yourself accordingly.
So how long
That's
do
the
you
approach.
typically hold the stock for? Does it vary? I mean, are you a swing trader? Do you normally buy and hold
Oh,
long? Is it
no, no.
different per stock?
So I don't want to label things, but I'll give you an example here. So I'm not a trader for sure, but the longest holding I have is last 5 years, 6 years. If it works, it works. Like Microsoft works, it sticks. So you just hold it. But last year, for example, I realized Google was one of my biggest holdings and I don't have it anymore. I have it in my family's portfolio, but I don't have it. I realize many things are changing and I just don't want to be involved in it. So it depends. It varies. But for example, stocks like LVMH I have since 2019-20. Microsoft as well. Palo Alto, I just keep adding. So many names, I just hold them. But eventually I realized some smaller holdings, they just don't work out. This year, I realized Google is not going to work out for me personally. I had Meta. It went up by 120, 130%. I said, well, the business is definitely not growing by 20%. So it doesn't match my portfolio criteria anymore. So I had to switch it, just being practical here. Because I know there's one opportunity cost, which is going to cost me 3 or 4 years down the line. That's my biggest issue. My biggest mistake is not going to show up right now because the market is recovering. My biggest mistake will show up 4 years later. Because imagine I could buy a nice business now and I'd say I'll sit with freaking Meta and then it's growing by 8% every year for the next 4 years. And I was like, shit, I needed to buy that other company 4 years ago. So
Just
the biggest mistakes,
hop in your time machine.
that's the thing, because the biggest mistakes, as I said, they won't show up right now. They'll show up 4 years down the line. So I always keep that in mind consistently.
Yeah, I definitely agree with Meta. I mean, it seems like it's just been going up every day now. And what I've been noticing is now that Meta stock is up, you're seeing the analysts, oh, $250 price target, $300 price target now. It's like, oh man.
By the way,
So
can I show something to your viewers, because I have a feeling they will like this.
yeah,
We can
go
do
for it.
two experiments. We'll do it with Jack and Daniel, and you'll see if you like this or not. So
We like to have fun here. Let's do it.
let's take the last 5-year performance of 3 tech names, and I want you to guess what happened with these names. Then we can use Google Finance and show this. So the 3 companies are Google with Google Cloud, Amazon, and then we'll add a third one, which is Oracle. Now tell me which one did the best. Which was the best performance last 5 years? Guess. Take a guess.
Last 5 years.
I mean, I'm bringing up this point, so you might as well think a bit out of the box here.
Yeah, it's probably
I was typing to the chat like a bad student in class and didn't hear the question.
I'm gonna say Oracle.
Okay,
just
sure.
because
So I will tell it to you, Jake, just so you know. So 3 tech names in the last 5 years. You just need to guess the performance of Google, Oracle, and Amazon, because all of them have cloud.
Sorry, is this
I'm
stock
excluding
performance or like revenue performance?
just stock performance last 5 years.
I can visualize.
Daniel said Oracle.
yes.
Number 1. Yeah,
It's
I
just
agree with
guessing,
Daniel
so
on
don't
this one.
worry. Okay, so could you show the last 5-year performance to your viewers just so they know? And then we can check
I'll bring it up.
Yeah, because I don't know how to do this. And then you'll see the financial performance as well. And I'll explain what happened here, because I have a feeling your viewers will really like this. And we can do this in the retail segment. We can do this in the tech segment. We can do it in the luxury segment. You pick the sector. I'll give you examples.
So I will be sharing my screen very quick, and feel free to guide my fingers here on the keyboard. Once I share, I cannot see you guys anymore.
Okay, so let's see.
Okay, so you said that you wanted to compare the stock price?
Right now, just the stock price of all these three players.
Okay, cool. I think market cap would also be a fair one. So we want to look at the last 5 years, you said.
Can you add
Let's do 5
Amazon?
years. Yeah, Amazon, Google, and Oracle.
And for those of you who are listening here, we are using the Stock and Lock freeform tool, and you can graph lots of different metrics. Why is Amazon not showing up? There you go.
It's probably because it's a small cap.
I got a really short attention span. Any other stocks you want to put in here besides
Nope.
Oracle?
Let's do these 5 years. And you, what do you see? What do you see here?
The CAGR of Google is double Oracle, and Google is in first place.
Well, wait a second. Is this correct? Because I used Google Finance and I saw different results.
Jake, you're going from 2019. Go 5 years.
But it's because he's doing the market cap. I think that's the thing. Could you just use Google Finance? Because that's where I check the results. Just to be sure. Yeah,
I mean, the stock price to me is sometimes
helps.
influenced by like the share count and things like that. But if you were just looking at stock price, then
So see, this is interesting. Now you see Oracle CAGR is 14%. It's actually more than Google, and it's higher than Amazon. Now this is interesting because Oracle in the last 5 years actually didn't grow so much. It just started growing this year.
Oh, really?
And and it's going to grow in the next 2 years. It's only going to grow in single digits. But here's what has happened. You can actually check shares outstanding of Oracle. And since 2011, they have actually halved it. So it was around 5.2 billion, something like this, 5.2, 5.3. Right now it's at 2.7 approx. So the shares outstanding in the case of Oracle in the last, since 2011, it's down by 50%. You go back. You're going to be surprised.
So they're buying back
farther than 2011?
Yeah, since 2011. Like it's crazy what this company has done. First, it was share. Does it show up?
Yep. So
so it says the percent change is minus 46%, and
there
then
you go.
As a CAGR, they are lowering it by 5% a year.
Instead of reinvesting back into the business and investing in businesses like Google, this company goes and buy back shares. Like literally, because it makes sense. The PE ratio was so cheap, and right now it has actually one of the highest PE ratios. It's around 31 right now.
And do you think a company should continue to buy back shares as the ratio goes up, or is there any limit there? Because we talk about this a lot, and we do like share buybacks. However, we think it's good, as you're saying, when the stock price is low. It does seem like you said it was low, and they started buying back, which would actually check boxes off for us.
Yeah, well, it's hard because technically, if you're giving dividends, you also need to consider taxes for shareholders and for the company as well. So if we are looking from tax efficiency perspective, buybacks makes more sense. Now, of course, initially you want the company to reinvest in the business, but if your return on capital is so low, buybacks is your only option. Yep. And you could say people like companies like Apple, for example, they have created shareholder value. Although they destroyed the balance sheet. If you check Apple's balance sheet, it's not the best because they have cash, but at the same time they keep increasing their debt. So I'm not a big fan of that financial engineering, but.
Yeah, I have a light rebuttal on this one. Not that there's a right or wrong here. I think another way to look at this instead of dividends or share buybacks, if a company is able to reinvest that cash in the business and get a higher ROIC than they would just giving the money back to shareholders in that way. If I had to pick between the three of those, so like I think Chewy is an example, Airbnb is an example. In these companies, 10Ks and 10Qs, they have management statements saying we have no plans of giving dividends. I think in Airbnb's case, there's a small exception where they offset share-based compensation through a share buyback program, which I actually think is nice just to keep the count level. But do you tend to favor one or the other, or is it still a company by company thing, Stockado, for buybacks or reinvestment in the business?
So I would say 40% of my portfolio, they reinvest nearly 40 to 50% of the cash. 30% is buybacks, and the rest 20% is dividend. I'm okay with that. And the rest 50%, they reinvest literally everything. Ideally, you want a business. I'll give the name anyways. It's also not a big company. It's Dino Polska. It's a Poland company. I'm not sure if Stock and Lock allows Poland companies. Does it?
Do you mind repeating that last part again?
Yeah, Dino Polska is the name. I'm not sure if the platform will take it, but please give it a try. DINO space POLSKA. There you go. So you have it. Yeah, check the
We
growth
have
rate.
all the stocks on Stock Unlock. I guess this one.
It's just a
Let's look
small
at this in
cap, so that's why.
ADR. So
Let's see if you can get the financials of this company. Just take a look at these numbers. This company reinvests 100% everything back into the business.
that's some
What
nice
an,
growth there. We could also look
what
at the insights too.
an amazing performance. Like that's the type of company you want to own. It's growing at a rapid pace. It's reinvesting
This is
everything.
exactly what you were talking about before, like high growth and profitability will come later. So I appreciate
No,
your
no.
consistency.
So this profitability actually won't increase because it's a retailer. It has grocery stores, so these numbers will optically look low.
Yeah.
So
Okay.
it's something like Costco and BJ. Like optically, these numbers do look low, but that makes the business even more efficient.
Yep.
But like it gave you literally everything. Like seriously, you can't complain. It gave you revenue growth. The business was growing. It's sustainable. Margins are sustainable, and the stock performance, it literally blew everyone out of the water. Like take any company you want. Take freaking Costco and compare it with Polska, and you'll realize that it's leaving Costco far behind by a wide margin.
Wow. Yeah, that's some pretty serious performance right
Yeah.
there.
You can also add BJ's because BJ did better than Costco,
Mhm.
but DJ Polska just leaves everyone behind. Like seriously, like there's a wide gap there.
Well, yeah, the data here on Stock Unlock is backing up every point you're making. So
There you
plus
go.
one.
I'm glad I did my research correctly then.
You're good. That's why we have this too. I don't know about you guys. I like to keep things written digitally, and it's made my memory pretty poor. So Stock Unlock is
No,
like my
but I
external
think the
version.
screenshot is really good because it just shows you the most important metrics you need, and you can screen everything in just 2 minutes. So this screenshot is everything you need.
Amazing.
This one precisely.
Yeah.
That's all you need.
Yeah, like this right here shows you really strong growth. ROIC is nice. ROCE is nice. So they're investing their capital well. And the gross margin, the margins are not the best, but I mean, as you said, for this company in specific, it doesn't look like that mattered too much. The stock still performed incredibly well.
Well, they're very
It's
consistent. So as Stockado saying,
yeah.
like, you can believe that they are going to keep this margin just based on history and saying as long
Yep.
as management stays the same, they stay in the same business. I agree with you. I don't really see this changing.
I say the margins are sustainable because it's like Walmart initially. So
Yep.
they're going basically in rural areas and small villages. So they don't even have any competition. So there's just one store there, and these guys will show up just like Walmart did initially. They're literally copying the entire playbook. And whenever they open a new store, the payback period is less than 2 years.
Wow.
Like they can reinvest everything right now, and the return on capital is more than 20%.
Yeah.
So these guys are saying, look, don't expect anything like free cash flows or dividends from us, guys. We need to grow here a lot. So that's exactly what they're doing.
Jake, can you check the operating cash flow on that one?
Definitely, yeah. And I even have the DCF up for it now, which is a little ridiculous, honestly. But I lowered it down to 20% growth rate, and it still had a very, very high future projected stock price, assuming that it trades at the same multiples and everything. Daniel, is this what you wanted here?
Yeah. So for companies like this, where they invest basically all of their money back into growth, this is the metric that I like to take a look at: is their operating cash flow growth. And this is basically exactly what I was expecting to see from this company. Is just nice, consistent operating cash flow growth.
Yep.
Yeah, I mean, that's awesome. I love that it's such a boring stock too.
You can thank me guys later. I'm done for today. See you guys later.
And we're going to have a new watch list called Stockado Picks here. And just
Oh, so do you want me to give you a list actually for your followers? Maybe they.
I would say, are you able to type in the chat? This isn't financial advice, but we're always down to share stock tickers.
How do I do this? I have no idea how to. It's the first time I'm doing this, so please apologize if I'm a bit messy here.
If we can't send it here, you can send it to us async. And for everyone who's in our Discord,
Sure.
we could share it there, as well as put it as a comment on the stream. So if you're watching the recording, we go into the comments and we will try to float that there for you. You can even do it on your own account. And with that being said, I did want to give you this opportunity. I know I have a hard stop in about 3.5 minutes for a friend's 30th birthday. I can't speak for Daniel, but do you want to just take a little bit of time, Stockado, to tell people where can we find you? Where are you online? I heard a rumor that you might have a YouTube account. This is a great place for other people who are.
It's just a rumor, Jake. It's just a rumor. So don't believe those lies. So I have 3 accounts. One is my YouTube channel, of course. The name is Stockado. Then you have my Twitter handle. It's Secret Monopoly. It's basically, as I like monopoly companies, like they are either number one or number two. So I wanted to name my channel accordingly. So it was Secret Monopolies, but I couldn't get my message through. Nobody knows why it's Secret Monopoly. So there you go.
So is this
And
the
then
at
and
which
then
cost? I just want to share the link for everyone.
at Secret Monopoly, at Secret Monopoly, I believe. Yeah.
All right, we'll post it after. I think I found a link to someone with a very similar name, so apologies.
Yeah. So the thing was, so now there's a bot account. It has the same Twitter handle. It's just there's one letter difference. I
Yeah.
tried to report that, so maybe your viewers can help me out here. And
Yeah,
then I
we'll
have
get it in the comments.
and thank you so much. And then I have Patreon as well, which I started just recently. So it was everything about my portfolio, and I make content there as well.
Yeah, I typed out the YouTube link and we have it on the screen right now. So anyone who wants to go and follow Stockado and check out his YouTube channel is right there on the screen. I would definitely recommend it.
Thank you so much. I really appreciate that. And do you have any questions from your viewers? If you want me to answer anything, I have the time.
All right, we have a question right here. Stockado, what's your take on what sectors will perform good in the next 5 to 10 years?
The ones which performed good in the last 2 years, because in the last 2 years, if you manage to grow, you're doing something right. Obviously,
Yes.
you'll witness a slowdown this year. So if you're still managed to grow this year, you've got things right. So I've covered the luxury sector. Please go ahead, Jake.
I was going to say, well, I wanted you to finish that one, but I was a little school child with the hand up for a question too. You said something about monopolies before. What's your favorite monopoly?
I'd say ASML. Yeah, let's go with ASML.
Why?
I'd say ASML because it's like a tax on everything. Like today we were talking about AI, machine learning, and everything else. This is like you need very strong compute power here, storage, compute, everything.
So just taking a small
And-
step back for our viewers, just
Sure.
in 30 seconds for people not familiar with this stock, just what do they do?
Yeah, I'll explain everything. So take your iPhones, for example, your latest iPhones. So these chips are made by Taiwan Semiconductor, and there's another company called Samsung. So both these companies, to make the latest chips, they need some machines called EUV machines. And that's what ASML does. Now, so ASML has a monopoly there. And then the previous technology is DUV machines, deep lithography machines. And ASML makes that as well. So the market share there is between 60 to 70%. So that's why I like those. So that's what ASML's business model is. So that's why I like it, because like everyone needs this company. And what you'll see is normally in the semiconductor sector, companies like AMD or NVIDIA, for example, they'll go up by 200%, then down by 200%. As a matter of fact, just for your viewers, take NVIDIA stock price, last 10 years, 15 years, and see the stock performance. You'll notice every 2 years, it goes down by 50%. You can do this in the last 6 years. If it doesn't happen, write me back. I'll prove it to you. So it's because I'm bored, so I do these things every day anyways. I'm like, let's see how much did Nvidia fall 4 years ago. So
we share a lot
that's
of love for nerdy stock data for sure. Definitely feeling that camaraderie here.
I love that. I love and support that, and I encourage that as well. So when you see the semiconductor sector, it's really volatile. So it's very hard to find companies that are growing sustainably, and ASML is one of those. It grows every year. And I forgot my initial question. It was about sectors.
I know that was great. It was just what was your favorite monopoly? I think you answered the question well. And one interesting thing here, my favorite questions are where we bring up points where we might not see eye to eye and see where we land. I have a lot of respect for you. I think, or I'm very convinced that I'm the dumbest person in the room. I looked into Intel stock. I looked into all these semiconductor companies. My background's in software engineering, which obviously isn't hardware. I tried reading through these companies' 10Ks and 10Qs, the vocab they're using, understanding the industry, knowing where it's going. Obviously, yes, like GPUs, AI, all that, it's great. It was impressive to hear you speak about the moat around some of the specific technology they had. Do you have any advice for me or other people in the chat as to how you could better understand some of these companies? Because right now I'm at water's edge and I'm very strict with myself. I will never invest in the company unless if I can explain it to a 5-year-old. And I cannot do that with any of these semiconductor companies today. Maybe you can.
Yeah. So firstly, I like to correct here just a bit because you said you're the dumbest investor here. I wouldn't agree with that. Just so you know. And I say this because it's just we are in different stages. Like I've been doing this for 8 years full time. So it wouldn't be fair to compare your performance with mine and your knowledge with mine. We're just in different stages. That's pretty much it. So it's not fair to say that, and I wouldn't say that.
Appreciate you.
But
Appreciate you. Thank you.
yeah, no, I really do. I really do mean that. And regarding sectors, well, start with the easiest thing. Start with sectors that are growing by 10 to 15%. That by itself, you'll filter out, I'd say, 90% of the sectors. There are not so many. That can actually grow every year, by the way, not just 1 year. So like 5 or 6 years. So Krishna asked which sectors will do well. So I can tell you the luxury sector will do well, the cybersecurity sector will do well, cloud sector will do well, certain banks in India will do well because the economy itself is growing. And once you have the sector, then you just go with the biggest player first. Go with number one. And what you notice is the number one player itself is growing by 20%, and you'll realize you don't need to bother with the rest. Because as an investor, if you're getting 20% returns, that by itself is enough. I mean, if you're ambitious and you think you know a lot, so then go with all these extra names. Like in the semiconductor industry, I have ASML, but then I just recently purchased one stock, which is a small cap, so that's why I'm a bit reluctant here, and that's growing by 100%, but the market cap is less than 1 billion. So don't do that. But if you do decide to do that, you can just do 80% of your money in the biggest company and then 10% in the smallest. So even if you lose it, you're still fine. But how do you understand the sector? I'd say in the first 2 years of your investing, just read everything about every sector. Don't invest your money. Just go with an index fund, but just understand some sectors. It's very hard to make money in an industry like Uber, for example. If they didn't figure it out in the first 10 years, it's not going to happen, guys. Because in the first 10 years, they were growing by 60%. Now it's growing by 15%. So best of luck with that.
What
But then
about
there's some
specifically with the semiconductor industry?
Yeah, so you just need to understand that in the semiconductor industry, there are two components. Firstly, it's logic. So you have companies like CPUs, GPUs, for example. That's really volatile. And then you have other industry, which is analog. So here you have companies like Texas Instruments. And when you see the stock performance, you'll notice that Texas Instruments is growing every year. So obviously that industry has some dynamics which are really important. And then once you dig in, you'll realize that Texas Instruments has products right now that they made 20 years ago. So 80% of the portfolio right now of Texas Instruments is products which they made 20 years ago. No wonders it's profitable. No wonders it has 50 to 60% operating margins. On top of it, this business is 70% direct to consumer. No wonders it has very high margins. Like, you don't need to understand the industry so much. Like, they're literally telling you, guys, we are doing this. That's pretty much it. So if two companies have 60% operating margins and two have 10% operating margins, obviously the numbers are telling you something. So then you just reverse engineer and you see, okay, so this company is doing this and this. For example, why does BJ has higher operating margins than Costco, for example? It's the same. But obviously there's something in BJ.
Thank you so much. That was a great deep dive. I know that I'm personally going to be listening to this again on Spotify podcast to make sure that I'm absorbing all of that. I cannot speak for Daniel here, and this is one of those conversations I feel that I could personally have and talk to you for hours. I mean, we have so much in common. I have a 30th birthday to get to. Daniel, we did not
have fun, Jake.
I know, Daniel, we usually think on this before the stream, so I'm not sure if you also have to dip, but I'm going to have to. All right. So any last comments you want to say to the viewers here, Stockado, also to Daniel? For me, it's just thank you so much. Please hit the like button if you enjoyed this stream. Don't only subscribe to us, subscribe to Stockado. Definitely deserves your subscription and is obviously also putting out great financial content. And Stock Unlock, of course, is going to be helping us all make better investing decisions and look at these metric growth rates and stuff like that. So thank you for being here.
Thank you so much for having me.
Yeah,
thank you so much. It's been a pleasure. I'm a huge fan of you guys. And I think I'm participating in all your live streams. I hope so. And I'll still participate. I love it whenever you talk about new stocks, because there are not so many channels that actually try and educate, because everyone wants to give you the names, the next 10x stock or 20x stock. Although maybe I should use that for the next title. I'm just kidding. So so everyone tries to give you names, and you guys are actually trying to educate with the platform. So it's really nice.
Thank you so much
for that.
Okay, so enjoy, Jake. I hope to see pictures from your side.
Yeah, maybe we'll do this again sometime. Thank you so much for joining, and we hope everyone has an amazing weekend. Happy stonks to all of you.
Okay, see ya.
I'm going to hit the button.